Hello and welcome to Lecture 15. We're going to be discussing international lending and financial crises. This comes from chapter 21 in your book. Let's get started. Let's talk a little bit about international lending. International lending are international flows of financial claims that can be divided into some different categories. So we can divide these international flows of financial claims by the type of lender or investor. They can be private or official. We'll discuss that a little bit more later. Maturity can either be long-term or short-term. Generally, when we are looking at long-term, that's anything more than a year. Short-term is anything less than a year. Existence of management control. So we're talking about foreign direct investment here, where a foreign entity will invest in another country. Type of borrower could be private or government. So let's first look at private lending and investing. We've got long-term private lending and investing. So it could be direct investment. This is investing in a foreign enterprise that's largely owned and controlled by the investor. So if Coca-Cola wants to move into Zambia, they can do that, and they could do that through a direct investment, and they control that, and the money gets more or less lent into that foreign country. Loans to foreign borrowers not controlled by the lender with maturity of more than 1 year, and this is mostly done by banks. So these are bank loans to foreign borrowers. Portfolio investments, purchasing stocks and bonds with maturity of more than 1 year. These are issued by a foreign government or a foreign enterprise not controlled by the investor. So in one example would be US investors investing in international stocks or bonds from another country. So those were long-term. We have short-term as well. This is lending to a foreign borrower not controlled by the lender, or purchasing bonds issued by a foreign government or a foreign enterprise not controlled by the investor. And of course, if it's short-term, it's maturing in 1 year or less. Also, we have what we call official lending and investing. Official. The official lending and investing is done by a government or a multilateral institution such as the IMF, International Monetary Fund, or the World Bank, mostly lending. Both long-term and short-term lending occurs. So what are the benefits from international lending? Well, it represents an intertemporal trade. So the word intertemporal, across time or within time, in which the lender gives up resources today in order to get more in the future. So the lender has money. They are giving up that money today in order to get more in the future. So they'll get paid more in the future. The borrower gets resources today, but must be willing to pay back more in the future. So that's the intertemporal, today versus the future. It allows lenders and investors to diversify their investments more broadly, which is true. When one country is struggling, or investments in one country, especially when we're looking at fixed income or lending type investments, maybe an interest rate is really, really low in one country but higher in another. So that would attract investors trying to diversify their investments abroad. So international lending and borrowing are often well behaved, meaning the players, the borrowers and the lenders have good intentions, and they behave well. They pay back the money the borrowers do. So lender and borrower usually benefit from the gains from intertemporal trade, as countries with net savings get higher returns and countries that are net borrowers pay lower costs. International financial investments are used to lower risk through portfolio diversification. So this is a way potentially to lower risk if you're an investor, because you've diversified outside of your home country. Conflicts can sometimes arise, however, over tax policies, but in a well-behaved environment, these conflicts are manageable. So sometimes international lending is not well behaved though. In a developing country financial crisis, the borrowing country experiences difficulties in servicing its debt and often defaults. And a default is when they fail to make payments as specified in the debt agreements. So let's say they borrowed, a country borrowed money from another country and they're unable to meet that debt payment. They can't afford to pay it. If they stop paying it, they've defaulted. And so this is when international lending is not well behaved. Lenders, when they see this happening, lenders will cut back or stop new lending. So they don't like the risk. It's not worth the risks. So they'll cut back because the borrower is viewed as too risky. So a lot of this happens as a result of lending to developing countries. So now we're going to talk a little bit about this lending to developing countries. So we're going to highlight a few different scenarios. One is the surge in international lending from 1974 to 1982. Now, these are all covered in great detail in your book, but we'll talk about each of these in this lecture. There's the debt crisis of 1982, the resurgence of capital flows in the 1990s, and then these financial crises. There's the Mexican crisis from 1994 to 95, the Asian crisis, 97, Russian crisis, and Argentina's crisis from 2001 to 2002. So let's start with a discussion on the surge in international lending. So we saw oil shocks in the 1970s. I'm guessing that none of you or very few of you might have been alive during this time. I was born in the late 70s, so I don't remember this time. But the oil shocks of the 1970s led to a surge in private international lending to developing countries. So there are four forces that combined to create this surge. First, rich oil exporting countries had a high short-run propensity to save out of their extra income, and they tended to invest these savings in liquid form, especially in bonds and bank deposits. So rich oil exporting countries had extra money and they saved it in bonds and bank deposits. Then there began to be widespread pessimism about the profitability of capital formation in industrialized countries. So the 1970s was an era of peak resistance to foreign direct investment, in which the foreign investors, usually a multinational firm based in an industrialized country, keeps controlling ownership of foreign affiliated enterprises. So there's a bit of pushback and resistance to these types of investments because the industrialized countries were taking advantage of the foreign countries. There was a herding behavior that meant that the lending to developing countries acquired a momentum of its own once it began to increase. So we saw the surge in international lending. We saw an uptick and increase because of all these different reasons from 1974 onward. Then we hit the debt crisis of 1982. So what caused the crisis in 1982? Interest rates increased sharply in the US as the US Federal Reserve shifted to a tighter monetary policy to reduce inflation. And my parents purchased a home near this time. I remember them telling me that their interest rate on their home mortgage was around 17%. Of course, later they refinanced, but rates were significantly higher than they are now. I'm right in the middle of refinancing at 2.75%, so we're in a much different environment than they were then. The US and several other industrialized countries were in a severe recession. Developing countries' exports declined and commodity prices fell while interest rates remained high. So the debtors' ability to repay fell dramatically. So we saw a significant amount of defaults. Here I wanted to show the net financial flows to developing countries. This is from 1981 to 1996. This is year by year by source type, and this is in billions of US dollars. So the net long term, you can see we can see it, especially in later years, growing significantly. So we went from 78 billion in 1981 up to 210 billion in 1996. Where did this come from? Where did this net long-term increase come from? Well, you can, if you look at foreign direct investment, this is the biggest increase, although private debt also did increase significantly. But you can see we went from 13 billion in 1981 clear up to 113 billion in 1996. So significant amount of foreign direct investment. You can see that total net financial flows were 238 billion. And that was the 210 plus 29. There's a rounding error somewhere in there. You can also see there are years where we have negative flows. This is where there are less flows, financial flows going into these developing countries. So money is coming out of those countries. Here we've got it from 1997 to 2012, and you can see the trend continues mostly, except for during the crisis, the slowdown, the bust of the internet boom from 2001 to 2002, but then it steadily increases year over year, mostly until 2012. We can see $1 trillion there. So where is the most of this growth in net financial flows to developing countries? As we look down here, we can see again the foreign direct investment remains fairly consistent on the increase, but we also see our private debt increased significantly as well. As with before, we see years where there are net outflows from developing countries, bank and other loans from 1999 through 2002, and then from 2002 to 2006, we see official loans outflows there. But in general, we can see that there's a significant amount of net financial flow to developing countries that has been increasing for the most part year over year. So this slide, we see the developing countries' external debt outstanding. So how much debt do they have from external sources? And this is again in billions of dollars. And this is not, doesn't have every year, but we've got select years from 1970 to 2012. You can see long-term debt has gone from 61 billion to 3.4 trillion dollars. That's a very, very large increase from the 70s onward. And you can see where the growth came from. In almost the area, you can see that external debt is a major source going out there. So one of the other things to look at is the debt to GNP, gross national product ratio. This is a percentage. So in 1970, the amount of external debt to gross national product was about 14%. We saw it rise to as high as 40% in 1995, but you can see we've come back down. So these countries' gross national product has increased significantly, and since 1995 has outstripped the growth in debt as well. So we can see that. Now let's talk about the resurgence of capital flows in the 1990s. The size and scope of the Brady Plan led investors to believe that the previous crisis was being resolved. Okay, so we had this debt crisis in 1982, which created a lot of concern and worry. And so in order to help to alleviate concerns, the Federal Reserve came up with a plan. It's named after Brady. I can't remember his first name now, but he, let me see, he was the U.S. Treasury Secretary, Nicholas Brady, He came up with a plan. Beginning in 1989, each debtor country could reach a deal in which its bank debt would be partially reduced, with most of the remaining loans repackaged as Brady bonds. And so this gave the opportunity for these debtor nations who were not able to pay as a result of the crisis that hit, the debt crisis of 1982 and through the 80s that continued. They were able to basically refinance at a very favorable situation. And so because of the size and scope of this Brady plan, it really did a lot to end the credit crisis and helped investors to feel more comfortable about lending again. So there was, at the time, low US interest rates led lenders to seek out higher returns through foreign investments. So within the US, the interest rates were low, and so lenders were looking for better returns outside of the US. Developing countries were becoming more attractive places to lend as their local governments reformed their policies. Greater freedom of trade and of factors that factor into trade. And so as the lenders saw this, they became more comfortable and willing to lend outside of the US. Individual investors, as well as mutual funds and pension funds, were also looking for new forms of portfolio investments that could raise returns and add diversification of risk. So this led to this resurgence of capital flows in the 1990s. But mid-1990s, we saw the Mexican crisis. And the cause of this, well, we see that the Mexican government replaced peso-denominated government debt with short-term dollar index government debt called teso bonos. Okay, so to outside investors, that made the government debt more attractive because it was indexed to the dollar. So exchange rate risk became less of an issue for these teso bonos. So there was a large flight of capital, mostly by Mexican residents, who feared a currency devaluation and shifted out of pesos. Okay, so a lot of money was leaving Mexico as a result. Investors refused to purchase new teso bonos to pay off those coming due because it appeared that the government did not have the ability to cover its dollar obligations. So as investors reassessed their investments in emerging markets, they pulled back not only in Mexico, but in many other countries. This is called the tequila effect, where it's a knock-on effect where investors not only lose their faith in one country's debt or ability to repay the debt, that spreads to other nations. However, the US government permitted Mexico to borrow money to pay off the teso bonos as they matured and to replenish its reserve holdings, which was helped significantly. Then in 1997, we had the Asian crisis. Sometimes you'll hear it referred to as the Asian contagion. It struck first in Thailand. Expectations of declining exports led to large declines in Thai stock prices and real estate values. And so this caused the exchange rate value to decline. It then spread to Indonesia, South Korea, Malaysia, and the Philippines. Foreign investors lost confidence in that region, in local bank borrowers and local stock markets. So the International Monetary Fund, the IMF, bailed out these nations, and this bailout contained the crisis, but these countries went on to very severe recessions. This is a chart showing these Asian countries we discussed. This is from 1994 to 2014. You can see on the y-axis, we've got the US dollar per unit of the currency. So we're looking at the exchange rate. So you can see what happened when the crisis hit, we can see it dropped significantly. The Indonesian currency has not recovered versus the US dollar. The others have, in varying respects, been able to recover some, with the Singapore dollar doing well. So you can see this crisis has had a significant effect for many years on exchange rates. Next, let's discuss the Russian crisis of 1998. There was a large fiscal deficit. Government borrowing led to rapid increases in government debt to both domestic and foreign lenders. The IMF organized a lending package, but Russia failed to enact policy changes included as conditions of the loan. And we see this not only in loans to governments, but large loans to corporations. The lenders can put specific conditions, and if the borrower cannot meet those conditions, then they're not allowed to borrow. The Russian government restructured its ruble-denominated debt, wiping out most of the creditors' value. The ruble depreciated because of a shift to a floating exchange rate. The IMF denied an additional loan, and a foreign lender sell-off ensued that caused stock and bond prices to plummet. Moving on, we've got Argentina's crisis from 2001 to 2002. Argentina's peso had a tightly fixed exchange rate to the US dollar, but Argentina lost the international price competitiveness. So appreciation of its real effective exchange rate happened. The fiscal deficit grew as economy went into recession in 1998. Private capital inflows stopped in 2000. Rising interest rates made this recession even worse. So the IMF also refused Argentina to make additional loans in late 2001. So banks were closed, peso depreciation of 75% in early 2002, the government defaults on its debt, and there was severe recession. Can you imagine if you had your money, let's say you had $1,000 in the bank, and the US dollar was depreciated by 75%? What that means is, basically, prices would have jumped significantly, making our dollar not able to buy as much. As a matter of fact, we would only be able to buy 25% of what we could have bought before. And so this was devastating for the people of Argentina. So looking at financial crises, what can and does go wrong? So number one, we usually start off with waves of overlending and overborrowing. Okay, so there's too much lending and borrowing going on. There's usually an exogenous negative international shock. Exogenous means from outside. So it may not be coming from within the nation. It could be an outside shock that is negative. Excessive exposure to exchange rate risk. So because of the way they've borrowed and lent, there is a significant amount of exposure to changes in exchange rate. Also, there's the fickle international short-term lending, where sometimes it's difficult for people to refinance their short-term debt. If they don't have the cash to pay it back, then they default, and it can create an issue which can spread. This can turn into global contagions. And so what we'll do is we're going to talk briefly about each of these on the following slides. First is ways of overlending and overborrowing. So we talked earlier about well-behaved and not well-behaved international lending. We're first going to discuss now these waves of overlending and overborrowing in well-behaved international lending. Lenders only lend and borrowers only borrow for investment projects that generate returns in the future that can be used to service the debt. This isn't always true, and we see that. So overlending or overborrowing can result from excessively expansionary government policies in the borrowing countries. leading to large government budget deficits that must be financed. So this can often come from an anticipation that these expansionary efforts will result in much larger revenues than actually happen. So overlending can also be to banks and other private borrowers. So once foreign lenders realize that too much has been lent and borrowed, each has the incentive to stop lending and to try to get repaid as quickly as possible before all of the available money runs out. So all cannot be repaid quickly and a financial crisis erupts. The excessive lending or borrowing that can lead to financial crisis is sometimes called a debt overhang, the amount by which the debt obligations exceed the present value of the payments that would be made to service the debt. So there's more debt than payments that can pay the debt. Okay, so that was one cause, one thing that can affect crises. Then we can see the next one is exogenous international shocks. These come from outside a country. When exogenous international shocks hit a country's economy, international lenders and the borrower must reassess the borrower's ability to meet its obligations to service its debt. So while the shocks originated outside, it affects the country's ability to repay their obligations potentially. For example, a decline in export earnings. So they're not able to earn as much from their exports, perhaps due to a decline in the world price of the country's key export commodity, makes it more difficult for the country to service its debt and thus more likely to default. And you can see this with nations, you can see this with the individuals as well. We have expectations that the revenues will continue the same in perpetuity into the future, so we make borrowing decisions based on that assumption that the revenue will continue. What happens in the case where we have our earnings or our income declines unexpectedly? Well, that's one potential problem that can lead to crises. Next is exchange rate risk. Sometimes the form of the debts can help us understand financial crises. So in the Mexican and Asian crises, private borrowers took on large liabilities denominated in foreign currency while acquiring assets valued in local currency. So they borrowed from outside of their home countries and took on large liabilities denominated in a different currency. And then they used the money to acquire assets valued in their local currency. So the borrowers took on these positions exposed to exchange rate risk because they expected that the government would continue to defend the fixed or heavily managed exchange rate value of the foreign currency. So governments up to that point were manipulating the exchange rate and having them fixed or heavily managed, and that would help protect these borrowers. Well, that can only go on so long. Too much pressure on the governments will result in them allowing the exchange rate to float freely, which really creates a situation for these Asian and Mexican, these Mexican and Asian borrowers. So when the likelihood of devaluation or depreciation becomes noticeable, the borrowers attempt to hedge their exposure by selling local currency. Okay, so they've got Mexican pesos or their Asian currency. They start selling it so that they can hedge their exposure to the debt in this foreign currency. This puts additional downward pressure on the exchange rate and makes it difficult for the government to defend a fixed exchange rate. So if the government gives up the fixed rate, borrowers will suffer losses to the extent that their positions are still unhedged, meaning they don't own this other currency. They're still owning their home currency, and when it is devalued, it makes it harder to pay back loans in another currency. Next is fickle international short-term lending. So debt that is due to be paid off soon can cause major problems. And you would think that this wouldn't be the case. This is a bit counterintuitive. You would think, well, if debt is about to be paid off or about to come due, then that shouldn't create issues. But foreign lenders can often refuse to refinance in the short term, which can create problems. Short-term debt is risky to the borrowing country because international lenders can readily shift from one equilibrium to another based on their opinion of the country's prospects. So if all of a sudden the country has poor prospects, that country may not be able to borrow again and may not be able to refinance their outstanding debt. In one equilibrium, the lenders refinance or roll over the short-term debt, and this can continue into the future. So if the expectation of the foreign lenders is that the country's prospects continue to be good, then they will lend and the borrowers will be able to refinance. But a rapid shift to another equilibrium in which lenders demand repayment is also possible. So if the borrowing country cannot come up with the payoff quickly, a financial crisis occurs. Finally, we've got the global contagion. This is when a crisis hits one country and then spreads to other countries or affects other countries. It appears that some kind of international contagion is at work, and we've seen this over time. Some contagion is the result of close trade links between the affected countries. So what affects America might affect Mexico or China because of our close trade links. Thus, a crisis downturn in one country has spillover effects in another country. Contagion can be an overreaction by foreign lenders as they engage in a scramble for the exit. So everybody's trying to get their money before there isn't any money left. Some lenders imitate other lenders who may have better information about the borrowers. So some lenders might have good information, see that there's a problem, head towards the exits, trying to get repaid. Other lenders will watch those lenders with more information and imitate them. Lenders fear that other borrowing countries are likely to have problems similar to those of the crisis country, even if there's no evidence of that being true. And so they will scramble for the exit in those other countries as well. So contagion can be belated recognition of true problems in similar countries. It can be a wake-up call. So how do we resolve financial crises? Well, there are rescue packages. We've seen this very recently, rescue packages as a result of COVID-19. Loans in the rescue package compensate for the lack of private lending during the crisis. So within our own nation, we've seen this happen where the US government has created loans for US businesses to compensate for the lack of available lending. Banks in crises tend to kind of clam up. They don't want to lend. And so governments have to come through with rescue packages. It restores investors' confidence by replenishing official reserve holdings. And it can limit contagion effects. Also, the International Monetary Fund can impose conditions as part of lending. So when they are part of the rescue package, they can impose conditions. And these conditions will usually help these countries to make the tough decisions that will help them get out of crisis more quickly. There can also be debt restructurings. This is a rescheduling, rescheduling changes when payments are due by pushing the repayments schedule further into the future. So rather than the debt being due short term, they might do a debt restructuring, allowing them to pay it back over a longer period. Reduction lowers the amount of the debt as well. So we see this with corporations too, when they run into financial problems and are unable to meet their debt obligations. Companies will often go into a form of bankruptcy that allows them to restructure wherein they will renegotiate or negotiate new debt terms with their debtors. This same thing can happen with countries as well. So here we see the IMF loans outstanding from 1970 to 2013. And so we've got a significant amount of loans outstanding, especially as we saw the crisis in the early 2000s. That dropped off. We saw a resurgence of loans through this period, and it's come back down. I wish we had this through 2020, because we'd probably see a significant jump up as a result of COVID-19. So this is the developing countries market-based rate, developing countries low rate, and here is the industrialized country. And so we can see outstanding loans from these different groups. So how do we reduce the frequency of financial crises? Number one, if countries follow sound national macroeconomic policies, it will reduce financial crises. This happens for a time, especially post-crisis. Governments will make wiser financial decisions, but as their economies improve and money starts to flow and things start to look good, they start to make worse and worse policies that can get them into trouble. Timely and accurate data reports can also help. They can catch the crises before they get too far out of hand. Avoiding short-term borrowing denominated in foreign currencies. So make sure that they don't have large amounts of debt that have to be paid back in the near term or short term that are denominated in other currencies. Also, better regulation and supervision of banks. And we see this at the end of a crisis. There's always new regulation to help or designed to try and help to avoid future crises. There are a few controversial things that happen or things to consider. Exchange rate policy, when governments will have exchange rate policies that can potentially harm other nations or their own home country if they don't properly consider all of the things that need to be considered. What truly is the role of the IMF? Also the use of capital controls. So just to conclude, we're going to discuss the global financial and economic crisis that we saw recently. Well, it led up to this. We had the expansionary US monetary policy. There was a global savings glut. We saw a huge housing price bubble in the US and some other countries. This led to a significant amount of subprime mortgages and mortgage-backed securities. Also increased debt and leverage overall. So beginning in August 2007, we saw a reduction and or freezing of short-term lending and investing, which created some issues. Then the US recession began in December 2007. Lehman Brothers failed September 15, 2008, which rippled through the markets. We saw intensified reduction in freezing and short-term financing. So lending dried up, especially short-term lending dried up. And this led to a global recession. So the other things to look at as we look at global financial and economic crisis, as discussed before, it usually begins with overlending and overborrowing. Then we saw the shocks such as Lehman Brothers and BNP Paribas. Then we saw the precarious short-term lending and funding as a result of the shadow banking system. So shadow banking system has to do with lending and borrowing by institutions that aren't traditional lenders. So they're not traditional banks. This is called a shadow banking system. So other entities got into lending, and there was less regulation and a lot more issues in the short-term lending as a result of the shadow banking system. This led to a contagion. Potential lenders and investors became less willing to refinance short-term debt. And this could be termed an equivalent of the run on the bank. So nobody was willing to relend to them. So also there were significant gaps in regulation and supervision of financial institutions. So post the 2007-2008 crisis, we've seen a significant amount of additional regulation in the US and other countries to try and help avoid similar crises in the future. So this ends our discussion. I highly encourage you to read through the book. I find it interesting, and having lived through many of these things, and in my working career experienced these times of crisis, it is challenging. And we have a time of crisis now with COVID-19 where we can see some of these same problems come up. This, however, could not have been foreseen with the pandemic, but the same types of problems result, and we have contagions, we've got difficult short-term lending situations, and it continues to spread. So governments have really stepped in and tried to make it so that the money is still flowing as freely as possible throughout the crisis. If you have any questions, feel free to give me a call, shoot me an email, and if you can't meet with me during my office hours, just suggest a time that might work for you. Thank you very much.